Look around you, different things born out of truth and passion. Business software, it's our craft, our identity. Thoughtfully engineered, passionately designed to help you transform your business. Zoho, made in India, made for the world.
Sanjeev Prasad, MD and co-head at Kotak Institutional Equities, joining in on the show right now. Sanjeev, hi, good morning. Great to have you on the show, and quite a bit of festive cheer, or at least anticipation, Sanjeev, especially after the GST rationalization. One is really hopeful of at least demand on ground picking up. What is your assumption on whether or not it's going to trickle through to earnings from this quarter itself, at least for, autos per se?
No, presumably there will be a reasonable pickup in demand for autos and hopefully also for consumer staples, some parts of consumer discretionary. Now, the bigger question is how long that sustains, but I think next 1 or 2 quarters should be good as far as these two items are concerned. And depending on when the 8th Pay Commission awards come through, if it is towards, let's say, middle of 2026, which looks a bit difficult. I would suspect it's more towards the end of calendar 2026, maybe third, fourth quarter of FY27. Hopefully, with additional money coming in the hands of government employees and over a period of time, even PSU employees, etc. Hopefully, the demand momentum can sustain. Having said that, the bigger issue is, ultimately job creation, and that will determine the longevity of the cycle. So the government has done its bit in terms of income tax cut, GST cut. Now it is up to the private sector to start investing, which can sustain the pickup in demand, which we will anyway see in the next few weeks.
Sanjeev, the concern for the market for the last quarter or two has been that earnings have seen a little bit of a slowdown. Other than the consumption piece, where else do you see signs of green shoots for an earnings revival?
The earnings concerns have been there for a while now, just not in the last 1 or 2 quarters. If you look at the last 12, 15 months, we have seen constant earning downward, which has, resulted in the market not going anywhere. Market has been pretty much flat over the last 12, 13 months now. If I remember correctly, for FY 2026, same time last year, in September 2024, we had about 1250, or slightly higher than that, EPS for the Nifty 50 index. That is now down to somewhere about 1090 or so. So that's been a very, very sharp cut. The positive news is at least last 1-2 months, we have not seen that level of downgrades. In fact, it's been fairly stable. And if I look at FY27 numbers, which are probably more important now, that's been stable at around 1400 for a while now. So hopefully, at least the earning downgrade cycle seems to be, I would say, hopefully getting over. The question is, do we see earnings upgrades from here? Maybe a bit early, I would say. See, we have seen some upgrades in the auto sector, which were understandable on the back of GST rate cut. But at the same time, we also seen downgrades in the IT services sector, which again is understandable given what is happening on the global demand situation. So far, they've offset each other. Now, beyond that, I think it's hard to make a case for big upgrades, given the investment cycle is still looking somewhat weakish, I would say. So that holds out most of the investment names, capital market, capital goods, etc. You come to the exports part, again, a lot of uncertainty over there. So I would rule that out for the time being. So that effectively leaves you with consumption, and where we already seen some amount of upgrades linked to the GST rate cuts.
Sanjeev, hi. This is Harsh here. Good morning. I want to try and firstly credit you. The last time we spoke, you were very, very clear that that move that the Nifty made between March and June, maybe 4th of June, it wasn't going to be followed by any material move, and that's exactly how it's played out. Now, if I were to zoom out, sir, over the last year, we've seen pretty much a negative 6% return on the Nifty 50 index. you're suggesting that earnings upgrades will likely happen only in FY27 is what I'm understanding. Confirm that for us, and therefore, what should the Nifty expectation likely be, maybe over the next 6 months to a year? Do you still reckon it to be sluggish given all of the uncertainty, or do you believe that a move may be warranted just given the consolidation we've been through?
If you look at the construct of the market, it looks like we have found some sort of a flow. Hopefully nothing goes wrong on the external front. But broadly speaking, as far as the domestic situation is concerned, we have a fairly stable macro, clearly improving growth, at least for the next 2-3 quarters linked to consumption, no issues on inflation and current account. So broadly speaking, you have a stable macro. We are probably at the last leg of the earning downward cycle, the point I was making earlier. And the last point on this is if I look at FY2027, it looks like it could be a fairly strong year for earnings. And we have somewhere about almost 18% growth for FY2027 now, compared to about 9% for FY2026. Remember, FY2025 was only 6.4% for the Nifty 50 index. So definitely a much better year as far as earnings are concerned for FY2027. So on the one side, we have reasonable positives that make us somewhat more, I would say, positive compared to the fairly negative view which we had in the market until recently, is that you have some sort of floor as far as the market is concerned. Now, what kind of upside we can expect will depend on, whether valuations sustain or not. Keep in mind the fact that market value is still very high, whether it is consumption name, investment names, most part of exports, etc. Valuations are fairly high versus historical levels. And this is at a time when earnings numbers are not looking that great compared to historical levels. And also, you're seeing a lot of medium-term disruption risks across sectors, which we have talked about for a long time.
Sure.
But having said that, if you make a simple, this is a very top-down macro view. Ultimately, you should look at stocks from a bottom-up view. Let's say we are looking at 18% earning growth for FY2027, which we get discounted over the next, let's say, 6-9 months. Even if you take some downgrades to that, let's say we end up with about 15%. You take about 5-7% derating the market, given the fact that multiples are on the higher side. Right. But you could still make maybe 5-10%, earning return, market return as far as the next 12 months is concerned. So that's the base case we're looking at, slightly more positive compared to where we were, let's say, 6 months or 12 months back.
Yeah, absolutely.
But having said that, don't get too carried away.
Sure.
Keep moderate expectations for now.
Sure. No, so absolutely. Point taken. Give us a sense. So you suggested that there are some pockets, some names where valuations are still slightly on the expensive side. Where is it that there is value holding, or where is it that earnings re-rating could well trigger upside? Banks was one thing in June that you suggested was a bit of a pain point given rate cuts. Do you see slightly better situation in terms of earnings likely to play out where the banking system is concerned overall? Does that feature as part of your list?
Yeah. So see, banks, at least it looks like we are at the end of the 3 negative which we have seen so far. 2Q FY26 should mark the bottom of the NIM downgrade cycle. Loan growth should hopefully start picking up, linked to what we've discussed on the consumption recovery part. And the credit cycle is not worsening anymore. For whatever data points we're tracking, and we have a lot of data on this, looks like credit cost seems to be, or credit situation seems to be stabilizing. So if you roll over to FY2027, between a combination of some recovery in loan growth, some recovery in NIMs, although we are only taking 10-20 basis point increase in NIMs compared to a very sharp compression that we have seen in FY2026 compared to the FY23, FY24 peak levels, and maybe flattish credit cost, you should see a reasonable recovery in the earning numbers of the banks. In fact, if you look at our own numbers for FY2027, we have about 23% growth in the net profits of the banks in the Nifty 50 index. That compares with the -4% decline for FY2026. So obviously, the base is low, which results in a much higher growth for FY2027. In fact, banks are one of the biggest contributors on incremental basis as far as Nifty 50 incremental profits are concerned. In fact, we're looking at about 35% incremental profits of the entire Nifty 50 coming from the banks. And valuations are reasonably okay. If you look at most of the PSU banks, they're between 0.8 to 1.1 times if you take SBI. That's about 1.1. Most others are at about 0.8, 0.9. If you look at the likes of, let's say, Axis, etc., they are more like at 1.7 times 1 year forward. If you look at HDFC Bank, ICICI, more like 2.2, 2.3 if you take out the value of non-bank businesses. So I think the tier one banks may not relate, but you would make money on the the increase in book value linked to ROE. That's about 14-15%. Tier two, tier three banks possibly could see some relating also, apart from whatever return you make linked to ROE, which is about 11-12% for most of the tier two, tier three banks.
Right. And then, of